Hey folks, Ross here. Today we're going to talk about rule of thumb valuations, when you can use them, and probably more likely when you should steer clear of them. In general, you're going to want to avoid rule of thumb valuations, mostly because some people have different sized thumbs, right?
Long spears, twice as long as a man.
That long? Some men are longer than others.
I know it's a shock, but that's a very important issue. When we're talking about rule of thumbs, you can use them when you are looking for a ballpark estimate, and you can use them when you want a little bit of justification for the results that you're getting. So it's what we call a sanity check. So let's start with the ballpark. When would you actually want a rule of thumb to give you a ballpark estimate? Let's say you're a bank, you're not quite sure if you're going to jump into this project that someone presents to you because you have no idea if the business is what they're telling you it's worth. So if you just had a couple of quick rules of thumb to go off of, then you can figure out if they're in the right ballpark. Or if you're a buyer of a business and you see a broker's listing of the asking price, if you have an idea of what the rule of thumbs in the marketplace are, sometimes you can just pick up that broker's prospectus and laugh it off, throw it away, move on to the next one. And other times you can figure out whether or not that means you should go and do your due diligence because it's a good deal, or at least it's in the right ballpark. But again, you never want to rely on a rule of thumb. You're not going to go and write a check based off of a rule of thumb. You're not going to run to the bank and say, give me this much money based on a rule of thumb. You just don't want to do business. You need more due diligence before you're actually buying that business. As an appraiser, I'll use rule of thumb kind of estimates to give me a sanity check on the work that I'm doing, or when I'm looking at someone else's work, it'll give me an idea of whether or not we're going to be in the right ballpark. So as far as a sanity check goes, you need to have some kind of basis for why you're using that number. When I'm dealing with restaurants, I consult a book from BVR. It's called The Guide to Restaurant Valuation. And in there, they've got different rules of thumb based off of different types of businesses. So, full service restaurant, they'll say, is worth 33% of their revenue. Casual style, 33% of the revenue. A diner, 30%. A nightclub, 25%. And here's the big one, sports bars, 40 to 45%. So if I do an appraisal of, say, a sports bar, it's got $1 million in revenue, and I get to the conclusion and it says that it's going to sell for about $400,000, at least I know I'm in the right ballpark. So it's a little bit of a sanity check, right? Well, not necessarily. Here's the problem with rules of thumb. If we put two identical businesses next to each other, let's take the sports bars for example. The one on the left, Sports Bar A, has $1 million in revenue. The one on the right, Sports Bar B, has $1 million in revenue. Sports Bar A returns to the owner $200,000 in profits at the end of the year, and Sports Bar B returns to the owner $300,000 in profits to the owner. Which one do you pick? Assume they're priced the same because we use a rule of thumb. The rule of thumb says they have $1 million in revenue. They're each worth between $400,000 and $450,000. That's it. We're done, right? Well, who on earth would pay the same price for these different levels of profitability? So the rule of thumb that I run into on a daily basis is in the dental world. So I mainly do dental practice appraisals. No matter what stats you look at, and I'm going to show you some stats from Pratt Stats. You could be looking at Goodwill Registry stats. You could be looking at state by state, regional. You're generally going to find that dental practices sell for around 60% of revenue, no matter where you are. For me, that's kind of the rule of thumb that I use. So if a practice is less profitable than its peers, I would expect that it's going to be below that 60% in revenue rule of thumb. If it's more profitable, I would expect it to be higher. No matter what city I'm in, if I pick up a broker's appraisal, if I'm in court against a broker, they're always going to say that the rule of thumb is that dental practices sell for somewhere around 0.7 to 0.8 times revenue. which is odd because that doesn't fit the statistics. And then they always back it up with, oh, but you don't understand this market. This market is so hot and so amazing right now that it's always 0.8, 0.75, whatever this number is that they're just making up. The statistics don't back it up, but their belief does. And it's kind of one of the problems with both a rule of thumb. We don't know whose thumb is really bigger, although I tend to trust statistics. That's just me. Brokers tend to trust what they believe, and they have a belief that's by nature tied to their bias within how they get paid. So of course brokers get paid off of the sales price, which means the higher you can get sales prices, the more money shows up in their pockets. So besides that, the biggest problem with using a rule of thumb is simply that it avoids all talk about profit. Ask yourself, what do banks care about? Do they care about profit or revenue? If you said revenue, you're really wrong. You're either going to need to watch more of these vlogs or you're going to have to keep listening. Banks care about profit. The reason why they care about profit is they want to get paid back. Remember that. How does Wall Street behave? When you're watching CNBC and they're talking about a particular stock, what are they usually talking about? Are they usually talking about top line revenue?
Is that investors are going to want something that they can quantify, which is earnings, which is dividends, which is cash flow.
Investors and bankers are interested in earnings. Why the hell would we be interested in a rule of thumb based off of just revenue? And you shouldn't be as a buyer. We're going to do it again for a dental practice. If I've got $1 million dental practice A in revenue, $1 million revenue dental practice B, they're identical except that dentist A makes $400,000 a year and dentist B makes $500,000 a year. A broker comes in and says, my rule of thumb says each dental practice is worth 70% of revenue. This one's $700,000, this one's $700,000. You should know better by now, right? As an investor, you want to own the practice that has $500,000 in profit going back to the dentist. The market should respond appropriately by increasing the price of practice B and decreasing the price of practice A. Or you can just start from the beginning, get a real appraisal from an appraiser, and you're already going to know what the fair market value of those two practices is. The reason for that is when you do a real appraisal, your focus is on earnings, not on revenue. With that, thank you for joining me, and I'll look forward to seeing you next week.